The era of low interest rates is behind us. The RBI has been raising interest rates, so inflation does not seem to be transitory, just like in the rest of the world. But only a part of it has been passed on by the banks to fixed deposit investors so far, because bankers did not feel the need to lure investors by raising deposit rates much, as there was enough liquidity available in the system. The recent drop in liquidity and increased credit demand could mean that more hikes in FD rates may bring some cheer to investors soon, but they may still need to view deposits through the lens of real returns, that is, returns post-inflation. So the question is, should you be investing in FDs now? But before we get into that, don't forget to like and share this video and subscribe to the Moneycontrol YouTube channel. The RBI's inflation projections were around 6.7% for the fiscal FY23, while the FD rates for the 3 to 5 years tenure in a range of 5.5% to 6.5%. Now, this indicates that the average FD investor continues to lose money net of inflation. On top of that, FD interest income is taxable. Therefore, both inflation and taxation eat into the gross returns. Now, one should therefore reflect on whether there is merit in investing in bank FDs, even as rates are going up. Nevertheless, you should leave aside some portion of your savings parked there for contingencies. Now the question is, what does an investor do to maintain returns which are ahead of inflation and also tax efficient? Now here are some ideas. Look for tax-friendly income or products like debt mutual funds and tax-free bonds. Short-term debt MFs like low-duration funds and ultra-short-term duration funds have started looking attractive as rate hikes have improved the yields of their portfolios. They invest in bonds which mature in the shorter term, and this helps them invest their proceeds at a higher investment rate on maturity. Thus, an investor can earn better yields from shorter-term debt funds compared to FDs when making short-term investment decisions. These funds also have an indexation benefit if held for more than 3 years. Therefore, they attract lesser tax as they are then taxed at long-term capital gains rates, which can be lower than the tax slab for higher income investors. But FD income has no such benefit. Hold-to-maturity debt funds can also be considered, which hold bonds that align to a target maturity date of the scheme. These are passive funds, which means they largely buy and hold bonds and do not have high portfolio turnovers. This helps reduce the cost of the portfolio. You can avail of the higher small savings rate that are still available. Products like the Public Provident Fund, post office schemes, the National Savings Certificate, the Kisan Vikas Patra, etc. are available at better rates than FDs. If you're comfortable with the lock-ins and possible issues with customer service on some of these products, then you can avail of these. You can also consider floating rate instruments such as the government's taxable bonds issued in 2020 with a yield of 7.15% per annum over 7 years. Since these are floating rate bonds, the rate linked to prevailing NSE rates plus 0.35% is expected to be reset every 6 months. In a rising rate scenario, this may be beneficial. In fact, we had also done a video on what floating rate bonds are. We've shared the link in the description. Do check it out sometime. Of course, senior citizens have other options that they can explore. Other investors may consider high-quality corporate deposits. All in all, higher interest rates have made multiple products more attractive than they used to be. However, you should always think through how they fit into your portfolio to deliver the appropriate outcomes for you. For more such videos, stay tuned to Moneycontrol.